Good evening, everyone. Welcome to this webinar conducted by us on the recent changes made by the GST Council. As everyone knows, we have completed 5 years under the GST law, and there were a host of issues which require attention, be it related to rate changes or clarifications or amendments. And the GST Council had not met for last several months. So they had quite a packed agenda when they met end of June last month, and have come out with several changes, which is going to have an impact in terms of the taxability or the procedural changes or refund changes. And we thought it would be a good idea to have this a conversation with you where we can discuss about the key changes that have been done by the council in last 1 month, where circulars and notifications have been issued. And then we can have a Q&A session where we'll be happy to take any questions that you may have relating to these changes. As you can see, the key changes we have basketed into 4 categories. The first is relating to the rate changes which has been done. Then we have seen amendments made to the refund provisions, whether relating to inverted duty structure or export of goods. Then we have various clarifications issued on contentious issues. Most of them largely welcome, as they may help in reducing litigations by the authorities. And last but not the least are the amendment made in terms of reporting requirements in the returns, which I'm sure will consume a lot of time and thought process from our side as to how to get these changes implemented qua the organizations. With this, I will request my colleagues Kulraj and Ruturaj to take you through these key changes. Handing over to Kulraj to take us through the rate changes and the other changes. Thereafter, Ruturaj will pitch in. Thank you.
Thanks, Neeraj. Good afternoon and welcome all. We'll start with the rate changes that were proposed by the GST Council and subsequently notified as well. The first set of changes, and we have categorized the rate changes into several baskets as per the relevance. The first set of changes were, and if you would kind of notice that the government has time and again been trying to rationalize the inverted duty structure, bring more and more goods out of that regime so that the complications of IDS to refund claim, credit of input services, capital goods being claimed, all that can be resolved. In this very thing, 2 very important goods were brought out of it, or the government tried to rationalize it. One was e-waste, for which rate was increased to 5 to 12%. The other was LED lamps, light and fixtures. There has been a long due demand of the LED industry to increase the rate of the final goods so as to get them out of the inverted duty structure. Besides this, the government, the GST Council, and subsequently the government has introduced several notifications wherein concessions and exemptions have so been removed on several good items. The first, and that we know more talked about, is the exemption being drawn out of these unbranded food items which carry the requirements under the pre-packaged or pre-labeled retail packages, which are packed as per the Retail Metrology Act and have appropriate declarations to it. There has been a lot of discussions, news, debates about all these, a lot of memes being created, whether what is the intent of it. So very precisely, government wants to tax all these unbranded food items which do carry a label requirement under the Legal Metrology Act. It has been clarified by the government that there have been a practice wherein several branded players have just tried to countervent the GST implication by not putting the brand and still try to sell the goods at an exempted rate. For all those goods, now there will be a tax implication as per the applicable GST rate, which could be food, grains, milk, curd, etc. if they are packed and if they are labeled and if they have a legal metrology declaration. There are certain exemptions from legal metrology declaration. Let's say the goods are sold to industrial consumers, or probably these goods are sold in a package above 30 kgs of size. In all such cases where there are exemption in the Legal Metrology Act, those items will continue to have a GST exemption as well. So very precisely, whatever a retail package, either be it food, grain, curd, have a requirement to place a sticker as per the Legal Metrology Act, all these would now be subject to a GST. Another rate concession withdrawn was respect to scientific and technical instrument when supplied to public funded research institution. those were subject to GST of 5%, and there were several debates about it. What will qualify to be a scientific and technical instrument? How should the certificate be issued by a public funded research institution, and so on? The government has put all these debates to an end by putting a higher rate or the applicable rate of GST in all such products. The concession has so been removed. While we've been seeing debates or concession being removed to an end consumer, this has not been true in all the cases. The government has tried to remove concession with respect to works contract, when a lot of contracts have been executed for government itself. Let's say it could be an irrigation work supplied to government, a historical monument, works contract services provided in relation to thereto, works contract for roads, bridges, construction of affordable housing societies, railways. All such works contract services were subject to a GST of 12%. As a result of this rate change, these will be subject to a high rate of 18%. This brings up to a significant debate, because most of these works contracts, when executed with government, have a tax inclusive contract. So these companies who enter this contract would need to get into discussions, debates, and probably negotiation with the government for a 6% arbitrage that they need to cover in future. Importantly, accommodation in hotel, guest house, club, campsite with a value of 1,000 rupees per day was exempted till now. Henceforth, it shall be taxed at 12%. So therefore, all these corporates who probably live in or probably reside in a remote location of the country, have a guest house, charge for a notional amount from their employees, will now have to pay a GST of 12% on this. A very significant taxability which has now been created and has been creating a wave of discussions in the industry is hospital rooms exceeding 5,000 rupees per day will be taxed at a GST of 5%. This brings into a lot of debate about this entire industry, why a healthcare industry being taxed, what happens when a hospital charges for an all-inclusive charges for a let's say a proper surgery where the room rental is also there, the healthcare services is also there. How would you create those bifurcations? Whether credit shall be so admissible to insurance companies or so no. So therefore, all these discussion points are there, which industry is still grappling to come up and cope up with. Another withdrawal of concession happens to services from Reserve Bank of India, SEBI, FSSI. Till now, they were exempted. Now they'll be put to 18% bracket. A taxpayer would need to see whether they will be coming under reverse charge, or will these institutions will constitute to charge a forward charge, because their constitution will have to be derived now. A significant amount of change has been done on the GTA services. GTA services, while we'll discuss about the change in taxability, but as we discussed, there were consignments which did not carry a value more than 750 rupees, or there was carriages up to 1,500 rupees of a value. Those have now been made taxable. Those were exempt, and they were exempt historical in the service tax regime as well. Another important change which affects all the registered persons is that when they take services of renting of residential dwelling from any person, those have been made subject to 18% GST, and that too under a reverse charge mechanism. This brings a lot of debate across the industry segment, because companies do take these residential accommodation for their promoters, directors, sometimes employees, sometimes guest houses as well. Everything will now become subject to a GST of 18%. The important question arises as to their creditability, whether they will get a credit of these GST paid on residential dwelling or not. And in our view, it depends upon the case-to-case situation, whether it could be said to be a personal consumption or a necessity of a business. All that needs to be seen on situation-to-situation basis. Other rate changes is under 9966 is a category where there's a renting of vehicle for transportation of goods, where cost of fuel is included in the consideration charge. Till now, it was subject to a GST of 18%. A new rate of 12% has so been prescribed for this category. There has been debate around this category, whether it will be a GTA services or renting services. The government has now tried to ensure that there's no rate arbitrage, because the GTA can very well charge a GST of 12%, and these services too attract a forward charge GST of 12% only. As I mentioned earlier, that there have been several changes with respect to GTA services. One important change is that GTA cannot pay a tax at 5% of forward charge mechanism. This brings into contention that there can be actually three kinds of rates in the GTA services: a GTA not charging any GST and a recipient paying GST at 5%, a GTA paying 5% at a forward charge mechanism, or a GTA paying 12% at a forward charge mechanism. So a registered person would need to see and have a contract clearly with the GTA on what rate would it be applicable. If it's a credit neutral situation, then a 5% reverse charge could be better, because then you will have a control of your taxes. All these factors would need to be kept into mind when you do a transaction with GTA henceforth. With this, we get to the refund related changes, and my colleague Ruturaj will take you forward for that. Ruturaj, over to you.
Yeah, good evening, everyone. On the refund side also, there have been a lot of changes. Some of them welcome, some of them questionable. So let's begin with the first change, which is with formula for computation of refund under inverted duty structure, or IDS as we call it. So the formula for computation of refund under IDS being substituted in order to factor the utilization of ITC on inputs as well as input services in the same proportion in which the credit has been taken in a particular month. This is a welcome change, because the effect of this change is that the quantum of refund will essentially go up. So anyone who has accumulated input tax credit and is claiming refund under IDS, the quantum of refund will undergo change. It will go on a higher side, and effectively the accumulation will come down faster relatively compared to the earlier formula. This formula change can be better understood if we see a numeric example, which we have on the next slide. So on the next slide, if we look at an example where we have talked about a taxpayer who has, let's say, IDS turnover taxable at the rate of 5%, which is 50 lakhs, turnover at normal rates at 50 lakhs, which makes total turnover of 1 CR. And the taxable person has input tax credit on inputs of 5 lakh rupees and input services of 2 lakh rupees. Now let's see how the refund was being computed in the older format. In the old format, the refund of IDS was computed on the basis of IDS turnover, which is 50 lakhs, divided by total turnover, that is 1 CR in this example, into the net credit. Net credit being credit availed on inputs, which in this example is 5 lakh rupees. So this works out to be 2.5 lakhs. And from this amount, what we were supposed to reduce is the total liability paid on IDS supplies. So in this example, the formula works out to be 0, because I am required to reduce entire 2.5 lakhs, which is being paid on the output liability of IDS. Now the change that we are seeing is that instead of reducing the entire tax liability on IDS supplies, what you're supposed to reduce is a proportionate amount factoring the utilization of input services. The effect will essentially be that the refund amount will be higher in the new formula. So as we can see in the present example, with the old formula, the refund for these numericals that we were getting was 0. Vis-a-vis for the new formula, the refund that we are getting is a figure that we can see, which is on a higher side. So this definitely is one welcome change that we have seen. This change basically has come into place because of, or rather factoring Supreme Court judgment in case of VKC footsteps, where the anomaly in the formula for inverted duty structure was noted by Supreme Court. And now the GST Council has also noted it, and we are seeing this change, which is a welcome change. Moving to the next change, which is in relation to re-availment of ITC on erroneous refund. Now, a lot of times it has happened with multiple taxpayers is that they have claimed refund, they have received the refund, and at a later stage, they have realized that this refund that they have received is erroneous, either on their own or most of the times tax authorities have pointed out that the refund that was granted to you was an erroneous refund. To give an example, any exporter who exports goods on payment of IGST should not have imported goods on advance authorization. So if you have imported goods under advance authorization claiming BCD and IGST exemption, then you're not allowed to claim refund of IGST paid on exports. Ignoring this rule, number of exporters have accidentally, inadvertently claimed refund of IGST paid on exports. And there are several notices which were issued across the board by authorities demanding this refund back, saying that this refund that you have got is an erroneous refund. Now, taxpayer acknowledged that this is an incorrect refund and they were willing to pay back this refund. The question was, what happens to the ITC which got utilized in payment of this IGST? Because there was no mechanism available to re-avail this credit of IGST which got utilized. What taxpayer used to do because of absence of mechanism is that they would claim this credit in GSTR 3B. Naturally, this credit was knocked back by GSTR 2B, and there was a mismatch between 2B, 3B, and this credit eventually was getting challenged. So absence of a mechanism was making exporters uncomfortable and shy to repay the refund amounts. Now we have an explicit mechanism for recredit of ITC, which has been prescribed in Circular 174. So the process which has been mentioned is that if an exporter or if a taxpayer repays refund in cash through DRC 03, then he needs to make an application on the portal to the proper officer, and proper officer, after verifying the claim, will recredit this amount in the electronic credit ledger. So there is no need to reclaim the credit through GSTR 3B, etc. Which is again a welcome move. This was a missing process which has been sort of made good for. Moving to the next changes, there is one important amendment which has been brought in form of an explanation. So, and it relates to the export value or value of export for purposes of ITC refund. What the amendment suggests is that for computing export value, when you're claiming refund of ITC and when you're computing value of export, you need to consider lower of the two values: A, the value which you have mentioned on the shipping bill, and B, the value which you have mentioned on your export invoice. Now, a lot of exporters will relate with this, that the value that they mention on the shipping bill need not necessarily match with the value that is reported on their export invoices because of the time gaps, foreign exchange fluctuations, etc. Now, the clarity or the amendment which has been proposed is that your export volume should be equivalent to the lowest of the two amounts and not the highest amount. Typically, one standard which most of the companies were following is that whatever is the FOB value, that was being used as a value of exports, and on that basis, the refund was being computed. Now, we have to make sure that either the FOB value on shipping bill or invoice value, whichever is lower, has to be factored. It will be interesting to note one thing, that this amendment which we are seeing has been introduced in form of an explanation. An explanation is typically considered to be retrospective in nature. So what may happen is that tax authorities may go back to the refunds which have been granted to check whether the refund was given on a lower value or was on a higher value. So that's something which will be an interesting area to watch out for as to how do authorities look at this amendment. There's one more change again to do with exports. This time, export of IGST paid on refund of IGST paid on export of goods. Now, any exporter who exports goods on payment of IGST doesn't have to file a separate refund application. All of us know that. When you file GSTR 1, when you file shipping bill, GSTR 3B, that itself works as your refund claim, and you don't have to have any other separate process. Later on, what happens is that in shipping bill and GSTR 1, there could be mismatches. Either the invoice number is not mentioned correctly, the port code is not mentioned correctly. There could be several mismatches which need to be rectified for the refund to be processed. The amendment which has come in suggests that it will be assumed or it will be deemed that the refund claim has been filed only after all the mismatches have been cleared out. So let's say you exported goods on 1st of a month, and it took you 2 months to rectify all the mistakes. The refund claim will be assumed to be filed after 2 months. That is the date on which you have rectified all the mismatches between GSTR 1 and the shipping bill. This is an important change. To really understand the impact of this change is that in an unlikely situation, let's say if an exporter misses out amending his GSTR 1 or fixing these gaps for 2 years, his refund claim will be deemed to be not filed, and he may actually lose out on the benefit of a refund. Another impact of this change will be, since your date of filing refund is getting postponed, any interest which the government will have to pay will also be computed from the date which is postponed. So that is the impact of this change. Next slide, we have one change which I would say is definitely welcome for anyone who has missed out on claiming export refunds. The timelines for claiming refunds have been extended. Now, for any refund of export to be claimed, or any refund needs to be filed within 2 years from the relevant date. So in case of export of goods, it will be 2 years from the date of export. In case of export of services, it will be 2 years from the receipt of foreign exchange, as the case may be. So the 2 years period need to be computed from the relevant date. Now, the change or the amendment that we are seeing is that period of 1st March 2020 to 28th February 2022. So period of 2 years in a way has to be excluded when you are computing the time limit for a refund. This is in a way in lines with there were several times Supreme Court had given a suo motu order extending timelines for compliances, and that order kept on getting renewed. So this is in a way in that lines. Only on the refund claims which have already been time barred, it sort of gives an extra timeline for claiming refund. So any refund, so if we speak of today, let's say as on July 26th, if you need to file any refund claims up to exports of August 2018 were in a way time barred. Now you have got a fresh lease, you have got a fresh 2 years period within which this refund can be claimed. So any exporter who has missed out on the benefit of claiming refund claim, this is a very important positive change that one needs to note. And if you have missed out on claiming refund, this is an opportunity for you to re-avail that credit. If you to re-avail or rather claim that refund, and also if you have filed refunds earlier which were otherwise deemed to be time barred, this amendment will make the refund claims filed after February 18 to be legitimate refund claims or refund claims which should be considered as eligible. So with that, I think we come to an end of refund related amendments. There are a lot of clarifications which have been given by the government. I'll request Puraj to take up the clarifications related to various aspects.
Sure, thanks, Rudra. So GST Council in its press release has recommended 5 specific clarifications to be introduced, besides several clarifications that they had put forth in the press release itself. Post that, these clarifications got introduced, and mostly these are on the very contentious issues which remains debated under GST. The first one, and possibly the most debated issue, is what happens to the employee perks that an employer gives. And why this debate is that one is that services provided by employer to an employee is not a supply under GST, but this is not vice versa. So when employer is giving any perquisite in form of a car, probably a motor vehicle, or a free rental accommodation, or a canteen facility, or a bus facility, what happens to its taxability? This is important because employee and employer are deemed to be related parties under GST, and therefore a taxability would arise even if there is no consideration attached to it. And there were rulings across lines to it. Some rulings said that GST is payable on the open market value. There were rulings to say that GST is not at all payable because it is not in the course of furtherance of business of the employer. There was a set of ruling which said that GST shall be payable on the amount that the employer recovers, deholds the open market value, and so many things were coming out of this. So to a certain extent, a clarification carves out a niche to it, which says that if there's any perquisite that the employer provides to an employee, and there is the perquisite provided because of a contractual arrangement, then there shall be no GST as far as that perquisite is concerned. So therefore, if there's a rent-free accommodation, if there is a motor vehicle and there's a contractual arrangement to provide that motor vehicle or rent-free accommodation, and there's no consideration attached to it even, then no GST will be payable on that. What is important is that the perquisite should be under a contractual agreement or an arrangement specifically. However, the circular seems to be still silent on perks, or I would say benefits, which are provided for a subsidized value, let's say canteen facility or a bus transportation, where an employer recovers a subsidized amount. The circular doesn't really provide whether this will be taxable or will not be taxable, or taxability will arise to what extent. It would have been ideal that the government should have provided a clarification on that extent as well. But as we speak, we still have certain clarity that open market value will not arise in case of a perquisite that is provided by an employer to an employee under a contractual arrangement. Second, again, the government has tried to reduce debates around ITC, and one such debate that was there, and a very typical debate that was there. So section 17(5)(b), which provides for ITC restriction, had 3 clauses to it. First clause, it talks about credit denial on outdoor catering, food, rental, leasing services. Second was on membership of club, etc. And third talked about travel benefit extended to an employee. There was a proviso that was there, and surprisingly, first and second clause had colons at the end of it, and third has a semicolon to it, and third had a colon to it. And there was a proviso which said that if any supply is provided by an employer to an employee due to any obligation under any law in the force, then the restrictions will not so be applicable. There were debates to it that if, let's say, a food and beverage or a medical treatment is provided by an employer because of an obligation under the law, whether that proviso will support it or not. Certain advanced rulings said that no, the proviso shall only be read in respect of subclause 3, not in respect of subclause 1 or 2. The clarification has made it clear that the proviso shall be applicable to section 17(5)(b) all put together. So therefore, now canteen, employee health insurance, if provided under any obligation of a law in force, the credit shall now be available. The restriction under section 17(5)(b) will no longer be applicable. Another interesting debate that is running through this, that how can the balance of electronic credit ledger be utilized? The clarification is said that the ECL balance can be utilized for payment of any self-assessed tax in the return or payment of any amount that is arising of any proceeding under the GST law. It, however, also clarifies that ECL balance cannot be utilized for payment of reverse charge liability, interest, penalty, late fees, or any amount of erroneous refund which needs to be necessarily deposited in cash only. This is a welcome clarification because there have been debates around it that what shall ECL be used for. Now it has put all those debates to an end by saying that the ECL balance can be used for payment of any liability and any proceeding under the GST law. Again, there was an instruction under 9C, which in 9 GST 9 where it got introduced to say that if any liability arises for the annual return, that can be paid only through electronic cash ledger. There were assessees who had paid these liabilities to electronic credit ledger and they were show cause notices to them. Now it puts together all these show cause notices, all the dispute to rest. So ECL is a sacrosanct balance and can be used for payment of any liability that arises from any GST proceedings. Last and one important clarification is regarding fake invoicing. While this clarification was a lot wanted because there have been a lot of reports around invoicing without actual supply of goods and services, and department has been trying to catch hold of every chain across the fake invoicing, every chain across the every person across the chain. The clarification provides that it shall be the ultimate recipient who shall be liable to pay GST on accounts of credit that they have availed against the fake invoicing. The people or the parties in the chain, let's say there is A, B, and C party, A and B who have issued these invoices without actual supply of goods and services or not to have paid any tax at any point of time. So therefore, there cannot be any tax recovery against them. There cannot be any credit recoveries against them. If there is an ultimate recipient, which is the C party, will only be liable to make good the ITC that they have availed on account of good on account of that invoice, which is actually without a good or services. However, the clarification has also clarified that there could be penal implication on all across all the parties across the chain. What is important is that the circular has also let it open that the penal proceedings under 132 can be invoked against all the parties. So that is an important thing. But what this clarification actually helps us to establish that multiplicity of demand happening in a proceeding where there is allegation of fake invoicing is no more there. So ultimately, it will be the ultimate recipient. Question, however, still remains that how will the ultimate recipient be determined in the entire chain? Whether the department will have any owners to go to the ultimate recipient or they will find any person who is in the chain to be the recipient of that transaction. So those debates will continue, but still the circular is of helpful to the assessee who gets caught in the web without being actually involved in these transactions. With these, we move to the last and important change regarding the compliance and process changes, which will cover the return filing part and the process changes. I'll have my colleague taking over, Ruturaj, taking over this part of the presentation. Ruturaj, over to you.
Yeah, this I think is perhaps the most important change because this is something which everyone will have to deal with on a month-on-month basis, on a regular basis. So the first important change which has happened in case of compliances or processes, I would say, is the change in GSTR 3B, which is on the next slide. So there have been several changes or amendments which have made in the form GSTR 3B. As of now, these changes have not been made on the portal. So if you log in and if you tried filing your GSTR 3B, you would not see these changes. These have been amended in the rules. These are yet to be incorporated in at a portal level. First change is in relation to manner of reporting services which are provided through e-com companies, wherein the e-commerce company is supposed to pay tax under reverse charge. So there is a separate provision made in the GSTR 3B to report these kind of supplies. The next change, which I think is applicable to everyone, and one of the reasons why most of the participants have joined this call is because of this particular amendment, I think, is change in relation to manner in which input tax credit is to be reported. In GSTR 3B, as all of us know, in part 4, we are required to report input tax credit, which is availed, input tax credit, which is reversed, what is the net input tax credit, and then there are some general declaration which are mentioned in GSTR 3B. These have proposed to be amended, or these have been changed now. And several mandatory disclosures have been incorporated in GSTR 3B. So typically what was happening is that by and large, every organization or most of the organization was availing input tax credit on a net basis. So for example, let's say in a particular month, you have availed several input services, which also includes rent-a-cab service, canteen service, etc., which are covered under section 17(5), and you're not allowed to take input tax credit of that. By and large, what was happening is that these services or the input tax credit on such ineligible services was getting expensed off, and only the net credit was being availed. So whatever credit was availed in GSTR 3B was itself net credit after minusing these ineligible credits, and therefore no separate reversal was being taken in respect of that. Now, what is expected is that there are some mandatory reversals which will have to be reported in the GSTR 3B. In fact, these reversals have been sort of bifurcated into, or can be bifurcated into two types. One is permanent reversal and one is temporary reversal. This is not the nomenclature used in the GSTR 3B form, but if you try to see the type of reversals which have been clubbed together, all those credits which are not at all available to a particular taxpayer will have to be reversed and reported in a particular section, and credits which you reverse and then you re-avail. For example, when you reverse credit for non-payment to a vendor within 180 days, and then you are going to reclaim this credit once you make the payment, or these could be termed as temporary reversals, which are to be reported separately. These changes will have a significant impact in the way in which we report credit. If you see, and in the next slide, we will see what is the exact change which we are going to see in GSTR 3B, but the net effect of this change. So what happens if I look at my electronic credit ledger, what is getting hit to electronic credit ledger is not going to change in the old form vis-a-vis the new form. In spite of that, what I report in GSTR 3B will undergo a change. Also, the way in which we undertake our reconciliation exercise at the time of preparation of GSTR 3B will undergo a change. Now, what you can see on the screen is old form vis-a-vis the new form. In old form, if you see part 4, we talk about eligible ITC. 4A, we mention what is the ITC available on import of goods, services, etc., and all other ITC. There is no change in respect of 4A, which is proposed or which has been carried out. In 4B, we need to mention, earlier we were required to mention what are the ITC reversed under Rule 42, 43, and any other reversals that you were making were required to be mentioned at 4B. And then this will work out what is the net available ITC. As I was mentioning earlier, usual practice which was being followed by a number of companies is that, let's say you are not eligible to get credit of certain services, you will not incorporate it in 4A itself. And that's why it was also not being incorporated in 4B. The net credit was appropriately being availed. Now, if you see what is changed is in 4B, there are two types of declarations that we have to report. One, whatever are the reversals under Rule 38, which is applicable for banking, insurance companies, etc. Rule 42, 43 reversals and reversals in relation to section 17(5). That is something that I'm supposed to report in 4B. the impact of that will be I'll have to take entire credit in 4A first and then report this amount explicitly as a reversal, and then my net credit will be arrived. So if today I was simply expensing out all the ineligible credits, I will not be able to do that. I mean, while I can continue the accounting method for purposes of reporting, I'll have to report this credit as availed and then reversed. This is something which is I was referring to as permanent reversals. The other category will be of temporary reversals. Now, there will be number of credits which will appear in GSTR 2B. For example, let's say a vendor has reported his invoice on in a particular GSTR 1, but the goods have not yet been received by the company, or the service invoice has not yet been booked in the particular company. So while the amount is appearing in GSTR 2B, I will not be availing credit in this particular 3B. All these invoices as of now, or all these input tax credits were as of now not featuring anywhere in the GSTR 3B. Nobody was reporting these type of credits. So typically it is called as not in my data. So in GSTR 2B, but not in my data, that category was not forming part of GSTR 3B at all, because it was, the credit was not being availed. Now what we have to do is, in a way, the beginning point of GSTR 3B, or the beginning point of credit to be taken in GSTR 3B, in some way will have to be the credit that is appearing in your GSTR 2B. Whatever is appearing in GSTR 2B will in a way have to be reported in 4A. From that, whatever is ineligible will have to be reversed in 4B1. Whatever is eligible, but I am not yet received the goods, I have not yet accounted the invoices, etc., will be reported in 4B2. So if you see the way in which my credit is being availed eventually, there is no change. Today also, if there is a particular invoice which I have not received, I am not availing credit of that. Tomorrow also, I'm not going to be availing credit of that. I am simply reporting that in 4A, and I'm also reporting that in 4B. Net, my credit which is hitting my electronic credit ledger is remaining same. In spite of that, I'll have to make a lot of changes in which I report my input tax credit. So today, for example, every organization, every taxpayer, the way in which GSTR 3B is prepared is that you look at your purchase register or ITC register, you compare it with your GSTR 2B. Whatever is the match credit, that's what you report in 4A, and that's about it. Now I'll have to also sort of do a reverse reconciliation. I'll have to factor in what is there in 2B, but not there in my returns. I'll have to nevertheless include that in 4A, and then again report it in 4B. If you notice, it's only a reporting amendment. It is not having any bearing on the credit that is coming to your electronic credit ledger month on month. But this is a big change. This will entail at some level changes at an ERP level also. For example, if you're simply expensing out ineligible items without bringing them into ITC GL at all, maybe there will be some tweaks which will have to be made there. So this is in a way a big change. Apart from that, in 4D, in the earlier form, what we were required to report was credit which was not available as per section 17.5 and any other credit. This was something which was to be reported in D. Whatever you report in D will not have any bearing on the net ITC which is available. So any amount that you report in 4D1 or 2 will not have any impact on the net credit. This is more of a disclosure. So now that section 17.5 related ineligible credits have already been incorporated in 4B, that has been that is not required to be reported in 4D1. Instead, what I'm supposed to report here is that any credit which is considered as ineligible in GSTR 2B. So for example, let's say you're filing a return in Maharashtra and the place of supply is not 27, it's some other state. That credit will be reported as ineligible credit in 2B. All such types of credits will have to be reported in 4D. Like I mentioned, this is more of a reporting requirement that will not have any bearing on your net credit taken. So this is one very, very important change, and there was a lot of confusion which happened as soon as this change was introduced. So this change came in early July, and all of us were in process of filing GSTR 3D for the month of June, and the question was, what do I do? Whether I should consider it in the month of June, whether it is mandatory for me to, adhere to these norms, etc. After everyone is done filing GSTR 3B on 22nd, there was one advisory which was issued, which mentioned that since these changes have not yet been made in portal, as of now, till the time these changes are incorporated in portal, one does not have to follow these. So, assuming that till the time of filing July return, these changes have not been incorporated in portal, then perhaps for the month of July, we don't have to make reporting in this manner. But it's just a matter of 1 or 2 months. What is more important to take in mind is that the way in which you're computing your input tax credit, or the way in which your GSTR 3B is getting prepared, one has to start taking a notice of these changes, and we have to make sure that we start looking at these manner of reporting, the reverse reconciliation processes, etc. Because eventually, once the form is changed, we'll have to follow these revised manner of reporting. We can move to the next slide. Another important change is in relation to manner of calculating interest. Section 50, which deals with interest in case of short payment of tax, non-payment of tax, and in case of incorrect availment of credit. There were changes in that to the effect that interest on output liability should be paid only on net cash basis. So if I have input tax credit, and if I'm not paying differential tax or delayed tax with payment of in cash, then I don't have to pay any interest liability. There were amendments to that effect. The application of this has now been clarified. So we have a new rule 88B, which has been inserted, which explains manner in which interest needs to be computed. What has been specified is that, let's take an example. For the month of June, we had to file return. There were a number of transactions which were to be reported, and for whatever reasons, the GSTR 3B got filed delayed. It got filed delayed by 10 days, and I had to pay liability, but that entire liability was paid using input tax credit. In such case, I don't have to pay any interest. Any interest which will be applicable will be only on the cash component of the liability. So belated filing of GSTR 3B, if that is resulting into delayed payment of liability, and if such liability is paid in cash, only on the cash component will you compute interest. Now, any other scenario for which I'm required to pay interest on output liability. So let's say in the month of June, there were 400 supplies which I made. I filed my return in time, but later on I realized that actually there were 402 transactions and 2 invoices were missed out. And these 2 invoices I'm reporting in the GSTR 3B of July. Now here, for this case, whether or not I have input tax credit will not make a difference. The delayed liability that I'm filing post-filing of GSTR 3B for this particular month will have to be paid along with applicable interest, irrespective of the fact that whether I have input tax credit or not. This is very important. So one assumption which everyone had, or general notion that I'm seeing, is that if I have input tax credit, it's okay if I delay my reporting. That is actually not true. If you delay your entire return, if the entire return is getting filed delayed, you will get the benefit of net tax liability interest. But if only straight transactions are getting reported delayed, then interest will have to be computed on that, on the entire period, irrespective of eligibility, irrespective of availability of input tax credit. So this is one important change. As far as wrong availment of input tax credit, it's clarified that interest will be applicable only if input tax credit has been availed and utilized. So if you have availed credit and if you've not utilized it at all, there is no interest implication that is going to come on your way. So for example, let's say if I have availed input tax credit wrongly of 5 lakh rupees and I have electronic credit balance of 6 lakh rupees, 550,000, that's absolutely okay. I don't have to pay any interest. The minute my electronic credit ledger balance comes below this amount, so let's say the ineligible credit is 5 lakh and my electronic credit ledger balance comes below 5 lakh, is the point in time when it will be assumed that you have utilized the wrong credit, and then you have to pay interest from that date on till the time you reverse that credit. So this is the way in which interest will be computed for wrongful availment and utilization of input tax credit. Moving to the next set of amendment, which are more procedural, but it will have in a way big impact as far as ERP or the manner of invoice printing is concerned. This is applicable for all companies who are required to, who have threshold beyond e-invoicing requirements, but are not required to generate e-invoices because of the type of their business or because of the type of their organization. So for example, SEZ units, GTA service providers, insurance, banking companies, these are some of the taxpayers who are not required to issue e-invoice irrespective of their turnover. Now for such tax payers, what has been mentioned is that you don't have to you don't have to raise an e-invoice, but you need to give a declaration on the invoice saying that even if my aggregate turnover is exceeding the minimum requirement, I am not required to raise an e-invoice for this particular supply, and hence I am not raising an e-invoice. So you need to make a declaration on the invoice saying that you don't need to raise an e-invoice. This is typically applicable for specific type of taxpayers. This, while it's absolutely procedure and it will have to be implemented only once, it will entail change in the way in which your layout of invoices, and to that extent, there will be ERP changes which will have to be made. As of now, to begin with, I know some of the companies have started putting this declaration through a stamp, manual stamp, because making changes in ERP is not something which is as quick. So this is one important procedural change. I mean, I won't say very important, but it's a procedural change which will have an impact on specific set of supplies. The next slide, we have another extension of due dates. So we saw earlier that in case of refund, there has been an extension of due date or the timelines. Likewise, we also have extension of due dates as far as timeline for issuing any demand orders under section 73 for the year 17-18. Now, in terms of section 73, any demand order under section 73 can be issued within 3 years from the end of or from the due date of filing annual return. The due date for filing annual return for 17-18 was Jan. I mean, it kept on getting extended, and eventually the due date was 31st Jan 2020. So the original timeline for issuing any demand notices, any demand order for FY 17-18 was up to 31st Jan 2023. This timeline has been extended to 30th September 2023. So there is almost 8 months extension which the government has got to look at, to issue fresh show cause notices, hear them, and issue out demand orders. As far as the last date for section 74, where cases involving fraud, etc., there is no change. That continues to be 5 years from the date of filing annual return. There is one last procedural change which is relevant for anyone who has got pan-India operations and who has got multiple GST registration. So if I have cash balance in any one of my GST registration, and please note, this is cash balance and not credit balance. So if I have balance in my electronic cash ledger in a particular state, I can now have an option of transferring that cash balance from one state to other state. So your cash across state is fungible. There is a form GST PMT 09 which you'll have to file to transfer this cash. And with that, this transfer of cash among registrations of the same entity is possible. So with that, we come to an end for what we wanted to cover. I'm sure there are a lot of questions. I can already see some questions in the Q&A box. I would request you to type in your questions in the Q&A box. We will try and take up as many questions as we can in the time that is permitted. And any questions which we are not able to take right away because of the timing constraints, we will try and reach out to you through your email IDs. Neeraj and Kurat, I can begin with the question. So the first question that I can see is in relation to eligibility of ITC on renting. So the question is that renting of housing accommodation is now taxable. So whether ITC on that will be allowed? The first question on our list.
So let me have a go at that. I think this GST which becomes applicable on residential accommodation and to be paid by a GST registered entity, poses a paradox in the sense that while it is being paid by a business, and therefore the question is that whether it should be treated as a business expenditure and hence could be covered within the meaning of something which is spent in the course of business. Versus the fact that it's a residential accommodation, and I'm distinguishing here from a corporate guest house, which may be used for residential use. But if it's a residential accommodation, maybe for a employee or a senior management personnel of the company, then the question could be that whether this is an expenditure which is personal in nature. As you would be knowing that the GST law under section 17 specifically prohibits input tax credit on any expenditure which is personal in nature. So I guess this is going to pose a big dilemma, and I guess also the kind of treatment which is being done under the income tax law, whether it is considered as an expenditure in the course of business under section 37(1), where deduction is being claimed by the company, and the same is accepted as not being of expenditure in personal nature, could play a role in sort of coming to some conclusion. But it is definitely going to be litigative if input tax credit is taken, because the department is likely to see this as a personal consumption expenditure and will disallow the credits.
Okay. The next question that we have is whether change in inverted duty structure refund formula would be applicable to refund applications which is yet to be filed but related to last year. So the question is whether it should be retrospective or prospective. Neeraj, would you like to take a go for this one also?
Yeah. So actually, we need to look at two specific amendments. I mean, there have been several amendments by way of amendment to the rule. One is relating to the adoption of a lower value in case of exports, whether FOB or invoice, whichever is lower, that value needs to be adopted. And that has been brought in by way of adding an explanation to the rule. The second amendment is the change in the formula for the goods which are under the inverted duty structure regime. Now, if you look at the clarification which has been issued by the department, especially in the case of inverted duty structure, they have made it clear that it's a clarification which has been issued, especially taking into account the observations of the Supreme Court to say that where goods are being supplied, where input and output rate is the same goods have been supplied, but because of a concessional rate of duty being available on the output side, there is a lower rate which becomes payable, and hence the benefit of inverted duty structure becomes applicable. In that scenario, to take into account that a refund ought to be given, this amendment has been made. And to that extent, the circular clarifies, or rather uses the term that it is clarificatory in nature. And as we all know, any amendment which is clarificatory in nature, and especially if it is beneficial to the SSC, the courts have largely taken an interpretation that it should have a retrospective application, and therefore benefit ought to be extended in such cases. But interestingly, the same notification also makes an amendment, to adopt a lower value of FOB versus invoice, which in a way is going to create a liability for any exporter. We may have, let's say, three situations. One where application has been filed and refund has already been granted by the department. The second situation could be where application is filed, but the refund is yet to be granted. And the third is application is yet to be filed, but the exports have happened before the amendment has taken place. If you look at the effect of the amendment, it is going to result in a lower refund to the SSC. We believe that it ought to be read in prospective in nature, because any amendment which sort of has an impact of either increasing the liability or reducing the benefit which is available ought to be given a prospective effect, and therefore it should be read prospectively and not retrospectively. But as I said, it poses a dilemma. We have two amendments in the same notification. One where the argument could be that it has to be read retrospectively, and the other could be read as prospectively.
Kunal, next question I'd like to direct it to you. The question is about declarations on e-invoices. The question is that whether this declaration that we spoke about, whether it will be applicable even for B2C invoices.
So for B2C invoice, the invoicing per se is not applicable. So the requirement of declaration doesn't really arise at all. So this will be required when you have a B2B transaction where e-invoicing is mandatory, but you have been given a relaxation from generating of e-invoice. In such cases, you would need to mention this declaration.
The next question is about claiming credit of bill of entries which do not reflect in GSTR 2B. This typically happens on account of technical glitch that there is a bill of entry which is appearing in IceGate data, but it is not appearing in GSTR 2B. So Neeraj, the question is whether if a bill of entry is not appearing in 2B, whether importer should take credit of that or not.
Definitely, the credit has to be taken. It is eligible. If a required format has not captured those details, that does not mean that the credit will be denied. 2B is a mechanism or tool available which can give you the details, especially where the supplier has supplied goods and services, and whether they have filed returns or not. And in case of bill of entry, in any case, it is being filed by the importer himself, and the taxes have been paid by him. So all the requisite requirement in terms of having the duty paying documents, the proof of payment of taxes, everything is available. So the credit is definitely available in such cases.
Okay. The next question relates to GSTR 3B, and the question is that how to report credit note in GSTR 3B, because so maybe I'll take this question up. So this is something which we also encountered while we were filing GSTR 3B for the month of June. What is happening is that any credit note which gets reflected in your GSTR 2B, it reduces your input tax credit. And we were struggling to check as to whether whatever is the amount which is auto-populated in GSTR 2B, whether that is something which should be, and that comes as an automatic reversal in your auto-populated GSTR 3B. And the question is whether this entire credit note, which is auto-populating as a reversal in your 3B, should be reversed or not. And I think what one will have to do here is that if there is a particular invoice of which credit has been taken, and if the credit note relates to such invoice, naturally that credit note will have to be factored as a reversal, and that to that extent the credit will have to be reduced. But if the credit note has come out in respect of an invoice of which input tax credit has not been taken in present or earlier GSTR 3B, then that credit note will have to be ignored for the purposes of reporting credit note. There is one question. I hope the answer to that is yes, but it is more of a policy level question. I'll direct that to you. So the question is, like cash balance can be transferred for Pan India registration, is there a mechanism to transfer credit balance as well? And if yes, are these processes laid out by GST Council?
Unfortunately, no. While that have been a welcome relief,
Absolutely,
where you can transfer the excess credit lying in one location to be utilized. But as you know that the GST is something which is being implemented by the center and states, and each credit which is lying in a particular location, especially the state GST, is something which belongs to that particular state, and if it is used to pay a liability which is a central liability, then we have this settlement mechanism where they will be compensated by the central government and vice versa. So unless a similar mechanism is sort of worked out in the context of state GST and IGST as well, because 50% component of IGST also contains the state GST element, this is something which will not be sort of implemented. The hope could be in the case of central GST, especially because if central GST is something which is belonging totally to the central government, and then whether central GST balances can be sort of taken to other locations, that could be a kind of a wish list from the industry side to the government. But as of now, there is no indication that such proposal is being considered by the GST Council.
Okay. I think we are almost reaching our time limit. Can we take a couple of more questions? Because there are a lot of questions in Q&A. I don't think we'll be able to take all. But Neeraj, Kulraj, can we take a couple of more questions?
Sure, we can take, I think, last 2-3 questions, and then we can revert, wherever we are not able to take up in the course of this webinar.
Sure, sure. So one question which is relating to this taxability of residential accommodation. The question is that where a company is reimbursing residential rent to employee and rent agreement is in the name of employee, whether RCM provisions will be applicable. And I'm assuming in this question, the employee is unregistered.
Yeah, so I'll take it up. So in our view, it has to be seen qua the recipient, and if the recipient is not registered, as you mentioned, that it could be the employee, though there could be arrangement with the employer of reimbursing it up, the reversal liability will not so get attracted. This is subject to the fact that the invoice happens to be in the name of employee, they are not registered, and employee may have a backward arrangement of getting reimbursement. So in such a case, the reversal liability would not get triggered.
Okay, okay. Neeraj, one question which I think is there on everyone's mind, and I can see several participants have asked that question, is that what if this new pattern of GSTR 3P reporting is not followed? Will it count as a procedural lapse? I mean, whether it is mandatory to follow this manner of reporting or otherwise? I think this is one question which seems to be on the minds of many. So if you can address that on a overall basis.
Sure. See, if we see what is the objective of the reporting the input tax credit in the return, the prime objective is to give an estimate of the eligible credits which is available to a company, which can be utilized to pay the GST liability. Now, there have been several mechanisms which have been adopted by company, as we know. Either if something which has been identified as ineligible is directly taken to the expense account without parking it separately, or some companies follow a mechanism where it is parked separately, and therefore that sort of data is available, although they may or may not report it in the return in terms of identifying what is the ineligible category. And lastly, of course, the ideal case, which is sort of being put in the new format, where you start with the total GST that is being charged to the company, which comes in 2B, and then you go through the process of identifying what is eligible, ineligible, and reporting the ineligible ones. Now, if you look at why this has been sort of being insisted by the government, I think the biggest reason is the settlement of account which happens between the central and state. If you see the provisions, one of the provision or a couple of them actually relate to a situation where input tax credit which is ineligible is identified to a particular state. So if that data is available, then what will happen is that the payout that will happen from the central government to the state governments, there is a ready amount available which will be paid, which is identified to a particular state. Let me cite a very classic example, which is there in the context of a banking and financial services industry, where they are eligible to a 50% credit, and 50% is ineligible under Section 17(4). So what many companies tend to do is that because 50% is eligible, that's the amount which is sort of being reflected in the GSTR 3B as the eligible credit, and that is being used to pay the liability. But then what is ineligible is not identified or captured in the return. As a consequence of which, if the company is filing, let's say 15 returns in 15 different states, those ineligible credits are not identified to a particular state. And if it is not identified to a particular state, then as per the formula which is given under the IGST Act for settlement of accounts, it goes to a common pool where again it gets divided amongst various states as per a set formula. Now, what may happen is that there are a couple of things that can happen here. One is that the state does not get the money which it could have received much earlier if it was identified as an ineligible credit. Secondly, once it goes into a common pool, probably it may get a lesser share of the amount which otherwise they could have been entitled to in terms of 100% of the amount which is identified. Now it may be that somewhere you may gain and somewhere you may lose, but then the point is that I think the idea is that they want to get the share of the revenue which is identified to them at an earlier stage, and hence this entire exercise of seeking a reporting where ineligible credit is identified. Now if from a context of whether the company can get penalized, look, if there is no ineligible credit that has been taken, then clearly those provisions are not applicable to the company, and so long as the credits are correctly identified, there's nothing that the department can do in those cases. However, one can sort of if look at it to say that if there is a general default in terms of not filing a return in the required manner, etc., whether there could be some general penalty of a token amount, I mean, that one cannot rule out. But as I said, in terms of the larger compliance, so long as there is no ineligible credit that has been taken, it may not lead to any substantial default in terms of not reporting in this manner. But yes, you may see a lot of sort of insistence and pressure from the department side to file the returns and give this kind of data, because that will help them in settlement of their accounts.
Okay. I think that's very helpful. Maybe what we can do is we can just take one last question and then end the webinar, because we already overran by 10 minutes. But this one question I think we can take. So the question is about computation of interest. And the question is that if, let's say, liability payable or short paid is of 1 lakh rupees, the taxpayer has got 60,000 rupees in his electronic credit ledger and 40,000 rupees in his electronic cash ledger, which is already paid. It's not a fresh payment of cash. So in such situation, whether interest will be payable on the 40,000 balance, which is already available in the cash ledger and which is being utilized.
Let me take that one. I think it raises a couple of points, and some of these issues have actually been taken up by the SEC even before, by way of written in the High Court. And the question is that if there is some money which is lying in the cash ledger, whether that will be considered as payment of tax, or it's just a deposit. And the other consideration is that even if it is not payment of tax, essentially the money is not with the SSC. It is not there in their bank account, and they have parted with that money, and it is lying as a balance with the government. And the way the courts have interpreted the concept of interest to be compensatory in character and not penal in nature, the question is that whether the SSC has benefited in any manner by in such a situation where the money is lying in cash ledger and not being not debited to pay the tax. It'll be very interesting to see the outcome of those judgments, but there is a good argument to say that interest should not be liable in such cases, because there is no benefit that is accrued to the SSC.
All right. So I think with that, we will conclude the webinar. There are quite a few questions which we could not take because of the time availability. So whoever we were not able to answer today, we will reach out to you. We have your email IDs. We'll try and reach out to you and give your solve the questions through an email. Neeraj, any ending remarks you want to have?
No, so I think I hope this would be an interesting session for all of you, and the changes that has been brought in will require much more deliberation and discussion, and happy to have this conversation with you on a going forward basis. Thank you for attending.
Thank you.